welcome along to the November edition of the Lenders Roundtable. This is the collaboration between Property Tribes, our brokerage, Property Tribes Financial Services, and the lending community. And today we are joined by Nathan Waller of the Family Building Society and also Victoria from Property Tribes Financial Services. And guys, welcome along to the call. And Victoria, as is often the case, I'm going to just quickly start with you because this is actually the first Lenders Roundtable we've held since the budget. And I just wondered if you could give us a quick overview of how landlords have reacted to the budget in terms of their financing needs.
I definitely think people were holding their breath, waiting to see what was going to happen. And I don't think it was quite as disastrous as we thought. And I think a lot of people were sitting on the fence as to what to do with whether to sell up, whether to remortgage, do additional borrowing, buy more property. And it kind of opened the floodgates for people to say, do you know what, we are going to do something. So from that perspective, it's definitely been busy. I think from an interest rate point of view, I should say, obviously the Bank of England have reduced the interest rates, which is great. However, we are currently seeing the trend that the fixed rates are increasing due to swap rate market increases. So currently the fixed rate market is going up, and we are seeing that a lot of lenders are quite last minute increasing their interest rates. So whilst we've seen the positive with the Bank of England reducing, we are seeing this little blip of interest rates increasing at the moment. So the market is definitely still up and down and turbulent. But I think from the reactions from the budget, it's definitely made people make more of a decision as to what they want to do. And we are seeing inquiries for people purchasing more buy-to-let property, which I think is encouraging.
It's very encouraging to know that, yes. And Nathan, if I could come to you, just tell us a little bit about the Family Building Society, the sort of how extensive your buy-to-let range is and the kind of client profile that you particularly attract or prefer.
For those of you who may not have heard of us before, Family Building Society are a relatively small lender in the market if you compare us to kind of the big specialist and maybe high street lenders that people will kind of know and recognise. But from a lender, we've been around since 1896. So we've been around for a very, very long time. When we come to the buy-to-let side, we try to serve those that are maybe underserved by maybe the high street side of things. We will lend to landlords up to the age of 89 at application. So we do quite a lot of those. We'll lend to a landlord really from 19, as long as they've got their own residential mortgage. So those real kind of young first-time buyers that are maybe looking to get onto the housing market with their first buy-to-let as quickly as possible. Most, from my understanding, buy-to-let lenders will kind of look from kind of 21 plus, whereas we might look from 19 if they're in that fortunate circumstance, which sets us apart from some others. As I say, all up to the age of 89. We'll happily take that client that's the first-time landlord all the way to seasoned portfolio landlords. We do from personal names, limited companies, expats, and buy-to-let offset. So we've got quite a diverse kind of portfolio of products that we can offer for different types of customers depending on their situation.
Well, it's very interesting that you mentioned buy-to-let offset because I think this is a product that we don't actually talk about enough. And Victoria, we've had this actual conversation recently on Property Tribes, haven't we? Tell us a little bit about buy-to-let offset mortgages and the benefits of them.
So with reference to buy-to-let offsets, how they work is you have your mortgage and then you have an offset account that runs alongside it. And most lenders will give you the option that if you were to have money sitting in that offset, if we use round numbers and say you've got £100,000 mortgage and let's say you've got 25,000 that you want to put in an offset account to run alongside that mortgage, most lenders will either let you not pay interest on that £25,000 or reduce down your monthly mortgage payment. So that money almost is offset against that mortgage. So it has real benefits, especially from an interest perspective. And you can then draw down on that money. So let's say, for example, you then want to buy another property and you want to pay for it. You want to use a deposit, for example, rather than doing a further advance with the lender, you can then take that money out of the offset to then utilise for the deposit. So then you start paying interest on that full 100,000 again. But it's a really, really good flexible facility for landlords.
It sounds it. And Nathan, are the interest rates similar to your other buy-to-let range for an
Um,
offset?
so for an offset, it's slightly more expensive than a typical product. There's a couple of different reasons for that. Earlier in the conversation when you were talking to Victoria about the way the market is, unlike a traditional fixed rate mortgage, where from a lender's perspective, you get money in from depositors and you then protect yourself against any interest rate rises by using swap rates to kind of mitigate any risk. You can't really do that with an account where you're not quite sure what's going to be happening every single month, the amount of money that client's going to be offsetting or not offsetting, and what they're going to be utilizing it for. So it's a variable rate product. So because of that, it's ever so slightly higher, because ultimately the risk to us as a lender is ever so slightly higher, because if your customer is doing what they should be doing with this product, and my lender will potentially won't necessarily like this, but if your client is offsetting the 100% of that mortgage and they are paying no interest, we as a lender aren't necessarily making any money from that. And ultimately, from a business perspective, we ideally need to be making money to keep the doors open. So because of that inherent risk, when they are drawing that money out and utilizing it, then we need to be making that little bit more profit margin to protect ourselves against that time where the client is offsetting half or all of the mortgage. So it's a bit of a balancing act between them, because so it's ever so slightly more expensive, but you'd be looking at this moment in time 6.34% in comparison to probably what the market that you're seeing at the moment of maybe the kind of mid fives for fixed rate deals. But the one unique thing, especially on our product and how we operate as a lender, we charge a product fee of 999 on this product. So like you might be seeing high rate, low fees and things like that, or vice versa, of a low interest rate with a high fee. We're also one of the few lenders that don't charge fees upon product transfers. So you could have this product today and set it up for one valuation fee and one product fee. And that's really all you're going to be paying us as a lender to set this up. When in 2 years' time, at the end of that discounted variable rate comes up and you do a product switch with us, that 999 fee that we would be charging to a new customer today is not payable upon a product transfer. So rather than you ending up being in a position where you're adding fees and adding fees and adding fees and you're losing the equity in that property potentially, and then paying interest on it as well, you haven't got that with this product as well. So I think the benefits of this type of thing, and it's a fully flexible fund, and also if they decide they don't need the money, then just don't pay us any interest for the meantime. It's a good flexible alternative and forms a good part of an experienced landlord's kind of product range of funding. So it's not just a standard buy to let, it's an offset product, maybe other different types of funding that you can find out there that can be utilized on top of this as just well, we've seen landlords diversify their portfolio. This is diversifying their income, their kind of lending streams and their finance streams as well. So it's always worth having a look at.
I guess it's a bit like an alternative to bridging finance as well. When you think about it, if you've got a sum of money, if a landlord wanted to go to an auction, for example, there are lenders that you could use that offset facility, buy the property, and then you've not got the pressure and the additional cost that you have with the bridge. You haven't got to repay that necessarily in a 12-month period like you would with a bridge. So it can give you another option as opposed to using bridging finance, and I have seen that quite a lot.
Well, it's a good tool to have in your toolbox. And I think it's great that we've been able to discuss it on this call because, as I mentioned, I just don't think too many landlords are aware of it. And I think, obviously this is one of the benefits of working with a broker, that a broker, Victoria, you could obviously maybe have a chat with a client and see that this would be a suitable product for what they're trying to achieve. So, yeah. We need to talk more about it, I think.
And to say it's not going to be suitable for everybody, and that's the one thing, and that's the beauty of the industry that we're in. There's a multitude of different products, there's a multitude of different lenders out there, and this product might be ideally suited to a customer that's got an unencumbered property that just you maybe need to utilize the kind of secure some debt in it for a rainy day.
Mm.
Those that might have just one buy to let want to maximize their rental every single month or put as little deposit down, it may not suit that customer, but it will suit another. So, and that's to say, the beauty of this industry of there's a range of different products out there with a range of different lenders, and it's just understanding the right things that are suitable for you as a customer as well.
Oh, well said, Nathan. And, there's nothing that I cannot abide less than, snoozing equity. Equity should be hard at work.
Mm.
And it's good to have. This is almost like having some in your back pocket for if you want to do a quick transaction or you need
Yeah.
some money, very quickly. This sounds like a really good option.
Yeah.
Victoria, we often talk on Property Tribes about should I go for a 2-year, 3-year, 5-year fixed rate? I don't think those conversations are going to end anytime soon. But I think, for myself, when I came to do a remortgage recently, I I found it hard to decide what to do because everything is, as we've mentioned, is pretty much up in the air at the moment. In my instance, I went for a 1-year fixed because it gave me a bit of breathing space with a property that I wasn't quite sure what I was going to do with it. And I'd never really thought about 1-year fixes before until Property Tribes Financial Services brought it to my attention and said, "How about this?" So, what are you finding landlords are looking to fix long term, or are they now thinking more about tracker rates? I mean, are you seeing any trends in that regards?
It's so diversified, and it sounds a bit sitting on the fence when I say this, but it really is dependent on everybody's individual circumstances, but also how they treat their portfolio as the business. So I have landlords that only ever like to do 5-year fixed because it gives them 5 years of peace of mind. They're focused on increasing those rents so that when they then come to remortgage, they're going to have that increase in rent. So even if the interest rates are higher, they can kind of try and mitigate that. When we think about what happened a couple of years ago, we had a lot of landlords where the rent didn't meet the stress testing. So that's been a real focus for a lot of landlords. Mm-hmm. I then have the landlords that are wanting to ride the market. So they're going on the variable rates. They're, feel very strongly that rates are going to keep continuing to come down. So they're on the variable rate. And I've also seen again, looking at the 1 year, the 2 years, the 3 years. So it's really dependent on what, how their portfolio is structured. We have to have 5-year fixed rates sometimes because you do get more borrowing on a 5-year. So sometimes you are held over a bit of a barrel as such because you have to go for that 5-year fix to get that affordability. Where you're not in that position, it's just looking at all the different options that are available and also asking the question of if interest rates were to go up and your monthly mortgage payment was to go to X, how would that fit with your current portfolio setup? Could you afford that? How would it affect your profit margin, your plan for the future? What's your 5-year, 10-year plan for the portfolio? So it's looking at all those different elements. So it's not a one size fits all. I think that conversation of do we do 2-year, 5-year, variable, 1 year, that's always going to be there, especially as the market is so up and down at the moment. But the one thing I would say is there is certainly a cost for delay. So by trying to sort of wait and find out, think about what's going to happen, if your mortgage is due for renewal in the next 6 months, don't kind of leave it until month 4 or 5 to decide what to do. Get something locked in now because the majority of lenders will move you down to a lower interest rate at no cost if interest rates come down. Whereas at the moment, we're seeing a trend with their interest rates are going up. If you've waited, you might be paying £50, £60 a month more than what you were last month. So it's just, if you've got 6 months left on the mortgage, review it now.
Yeah, very, very good advice. And Nathan, are you seeing any particular trends of what landlords are doing?
From our side of things, the inquiries have certainly be coming in a little bit more looking at shorter term products, the kind of the 2-year compared to 5 years. Similar to what Victoria's just mentioned is some of it is more around the idea of they're hoping that the interest rates are going to go down, and therefore they don't mind paying a slightly higher interest rate for the meantime. in order to protect themselves against a variable rate, with hopefully then in the 2 year time, then the rate dropping down to kind of match it. Now, as you mentioned, it kind of depends around an individual. So some of them have properties for a bit of an income. Some of them have it more for capital growth. Some of them have it more as a long-term investment. And actually, the short-term situation now of them paying a slightly higher interest rate for the next 5 years doesn't really phase them too much, because they're looking at it as a 10, 15, 20-year investment. And like you say, is they're still paying for the security, and they're still happy to do it and say, you know what, we still don't really know what's going to happen. There's a lot of moving factors that you only need one or two things again to potentially happen, that all of a sudden rates might go up, they might go down. There is that little bit of uncertainty. The offset product, as we said, is one of those products that is beginning to pick up just because of that scenario. They've got something on their portfolio where they go, well, we can't get the stress rate on some of these, so they're monetizing one of their unencumbered and putting what they can in, and then they're filtering the rental into the offset, so that then it's doing the same thing by getting them onto a lower interest rate on a 2 year product with an alternative lender, and then everything they're getting through on profit is going into that to offset it. So then it kind of covers itself and protects itself that way, rather than overpaying on the mortgage. Others are still buying and kind of looking at changing the structure of their portfolio, where they're saying, well, actually, rather than just the normal houses that I was normally buying, or the normal flats that I'm buying, I'm now beginning to dabble into a multi-unit freehold block, for example. And they've seen on the market a house that's converted into 2 flats. And they said, well, I've never really thought about that before, but you know what? I'm going to dabble in that because I'm willing to take that little bit more risk, because the yield will be better, which then protects their portfolio against, well, what happens in this type of market. So we're seeing a range of different inquiries from a range of different people whose, again, circumstances are completely different. There will always be the element of they want something as cheap as possible to make as much money as possible, but there's always going to be the needs based of, it's great that you want to do that, but this is going to be the best option for you depending on what your long-term goals are. So we do offer a range of 2 year fixes, 5 year fixes, and discounted variables depending on what they are looking at doing on that type of scenario. So yes, is unfortunately it's not a straightforward answer, but there's it's not the same answer for every single customer. It's not just as simple as I want the cheapest possible rate at the lowest possible loan to value. It could be, well, I need to get 75% or 70% because that's what I need against that property, rather than, well, I want 60%, but I haven't got the money to get you to there. So again, it's not a straightforward answer. And again, what I'd always say to each individual kind of client and landlord listening to this type of podcast is, sit down with your advisor, work out what you want. And it's very difficult for someone like Victoria to be able to recommend the product or the right solution for you if you're not quite sure yourself as to what you want to do or where you want to go or what you're looking for. So just look at it, sit down, plan, and if you've got an idea of this is where you want to see this go over the next 5 or 10 years, then it really does help in the recommendation process to make sure that what product you're going for is the right one for you, rather than what your friend around the corner's got on their property. Because again, it depends on what they're doing compared to what you want to do.
Well, indeed. And that's very, very sound advice there, Nathan, because as you say, it's not a case of one size fits all. Everybody has different goals. Everybody has different circumstances. Some people, as you mentioned, are seeking cash flow on a month-on-month basis. Some people are more focused on the long-term capital growth, not so worried about cash flow. So there's almost certainly a product out there for everybody. And, working with your broker is very important. And I think, we struggle sometimes to find the positives in our sector at the moment. But I think one thing that is very positive is that rents are continuing to remain very robust. And that's good news as well from a lending point of view, isn't it, Victoria?
Absolutely. I think the biggest thing we had a couple of years ago when we saw the interest rates increase so much was that a lot of landlords have been so considerate to tenants and weren't necessarily charging them market rate because they were good tenants, they were looking after the property, but from a mortgage perspective, they hadn't increased them for a few years, and now the interest rates have gone up, it's not meeting the stress testing. So the fact that, especially over the last couple of years, a lot of landlords have been focused in increasing those rents, but also lenders have tried to be as flexible as they can to help landlords meet those stress testing rates, which is why we've had the introduction of these low interest rates with high fees, which I know some of them can be absolutely eye-watering. I saw there was like a 2.8% rate with a 10% fee, which is, you think about adding that onto the mortgage. However, whilst it's not a product that I would recommend for every single landlord, there may be a landlord out there that is the right product for them because they need it to meet the stress testing. It's going to save them money from going on the SVR, and it means that they get to keep the property and they don't have to sell it. So it's I think lenders have had to be quite creative with how they've tried to support landlords, and we're still seeing more products being developed and to try and support the landlords market, because it has been really tough for everybody over the last few years. It's just been crazy. But adding to that as well, I would say I'd recommend people to get good tax advice as well, speaking to tax advisors that understand property. So whilst, yes, you can speak to any accountant and they're going to know about tax, speaking to an accountant that's very proficient within the property world will help you business plan in the future, especially if you're looking at the limited company side, and if you've got an existing portfolio and you're wondering whether to put property in limited companies, get some good tax advice, because that will certainly help in the long run when you're planning out the business, increasing rents, etc.
Yeah, well, here. Nathan, just as we start to close this out now, obviously you're aware of the Renters' Rights Bill moving through Parliament. I'm interested to know what the lenders think of it, because with the removal of Section 21, or abolition of it, and moving to new grounds for possession via Section 8, I remember the sort of buy-to-let mortgage came into effect, I think it was in 1996, for two reasons. One, there was an assured short-hold tenancy. Secondly, the lenders knew that they could gain repossession via Section 21. Well, the assured short-hold tenancy is turning into the assured periodic tenancy, and Section 21 is going to be abolished. So have you had any discussions at your lender about the Renters' Rights Bill? Is it going to impact your lending decisions in any way, or your products in any way?
So at the moment in time, it's something that we are certainly keeping an eye on. There'll be an element of, from a lending perspective, there are obviously a couple of different customers that we've got to be mindful of. You've got the landlord at one end. You've got us, who we need to keep our doors open and protect our funders to some extent, because we're lending some of our money, we're keeping capital beside to protect against some of the mortgage book, but we're lending out our savers money to protect that. And also you do have the customer at the end of the day, which is the tenant, and you've got to kind of protect their rights on that side of things. So we're keeping quite a close eye on it. In our opinion, from what we've seen, they can't do too much. Ultimately, if it goes too far, then buy-to-let will almost cease to exist if from a lending perspective, our interests and our securities can't be taken possession of. So at this moment in time, we're just keeping a very close eye on it. And I think from any lender, if it goes too far, I would highly imagine that there will be a bit of an uproar from not just us, because I mean we're tiny in comparison, but the multitude of different lenders out there. And the one thing that I don't think that can afford to happen is the financial services side of things, which is one of the biggest industries in the country, to all of a sudden ground to a halt because all of a sudden buy-to-let lending can't be done. And there will no doubt be steering in regards to what can happen, how it can happen. And also from a lending perspective, we're quite resilient. And if we need to make adaptations and changes to try and keep it feasible, then we will. So I don't think that from our side of things and from a lender's perspective, we're following it, we're seeing how it goes, and we'll either adapt or we'll probably have to get involved, or the lending market will have to just get involved and say that you've gone too far. This is all going to come down horribly wrong because all of a sudden, what are you going to do? We're going to end up flooding the courts with stuff to say, well, these people need to get out because of a multitude of different reasons, and there are always reasons why. Might be a no fault eviction. It's not their fault. They need to go in, but there will always be a reasonable explanation for a lot of these things where actually possession does need to happen, and they do need the tenant. Unfortunately, does need to go somewhere because it has to. But there's no other way for this market to potentially continue. So I know it's not really a definitive, and it's quite an open-ended answer to this, unfortunately. But for one of the biggest industries, from the services industry perspective in the country, I don't think they can afford to get it wrong. And if anything does go wrong, it'll end up probably getting changed quite quickly if need be. But as I say, it's something that we are keeping an eye on.
Yes, I am aware that the lender community is involved in the committee stages and whatnot, which is very important that they are.
Yeah.
Did you want to say something else?
No, as I say, and it's just that it's the one thing that you can say for a lot of these types of things that go through Parliament is what normally starts off as what feels like a great idea. Then when they introduce the people who it affects, such as the lenders, and then get consultations through on that, what you'll eventually see at the very, very end will take into impact all of those discussions, and what they obviously you see at the very, very beginning, and once it starts going through, normally doesn't end up going through exactly how it is, and there's normally amendments and things that need to be made. So the one thing that normally we would see is those types of protections will be put in place for. There'll be tenant protections, there'll be lenders protections, because ultimately, if we can't lend, we will end up in trouble, which means that long term, then our savers' money is at risk, which they won't want to see either, because it's not just us as the lender that's at risk, it's actually the original customer that's given us the money in the first place. So from a building society perspective, I say we're funded from our members, primarily from savings accounts. There are a multitude of specialist lenders out there that are funded from money from investors. Some of that money comes from places like America, for example. So what they won't want to do is start shutting their doors to funding from outside sources, which helps build the economy. And one of the biggest things they're talking about now is growth. If that goes wrong, the growth will stop because no one's going to invest. No one's going to invest in the UK if they can't make the money on the money they're providing to us. So.
Well, exactly. And we've got a massive supply and demand imbalance here in the UK. Too many tenants, not enough rental properties. And we do need lending to be available to landlords to allow them to grow and to provide private sector housing, which many local authorities rely on to discharge their housing obligations into. So, yes, just to finish, really, if I could ask both of you, maybe Victoria first, are there reasons to be cheerful? And looking ahead to 2025, have you got any crystal ball activity going on?
If I did, I would be winning the lottery every week and having this call in a yacht somewhere in Barbados. I think there's lots to be positive about. I think we're definitely going to have a tough ride for the next few months while we wait for the market to settle down. There's been a lot of things going on in worldwide economy that have obviously affected spot rates. Touching upon what we were talking about just now, I was having a conversation with a lender this morning when we were talking about the renters
rights bill.
I can't remember what it's called then. And one of the things they were saying was that at the moment they don't look after any of the kind of Serco MERS type tenancy agreements. They could consider that in the future if this comes into play, because they would have to manage the properties no matter what. So they're saying that might fall into their risk profile. So I think lenders will be forced to diversify, which could then change how buy-to-let goes, and maybe landlords looking to diversify their portfolio can do so with more lenders coming into the HMO and the mud market, looking to do the more vulnerable tenants, that kind of thing. You won't just be stuck with the 5 lenders that currently we have available. So I think there are lots of things to be positive about. Hopefully we will see interest rates come down, and hopefully we will have some better news in 2025 on ways that landlords can be supported. And I have to say the lending community is trying to do that, trying to support landlords.
No, definitely, and hopefully less volatility as well, because we've seen NatWest rates go up, then down, and then up again in the same day. So it's quite extraordinary. So there's still a lot of volatility, I think, bubbling over from the budget and the other circumstances that we've touched on. So Nathan, your view of buy-to-let for 2025?
On our side of things, we're expecting it to still be a very buoyant market. There are a couple of different parts of our policy and products that we are looking at tweaking, and on the good side, to make changes, because we want to help support the landlord and we want to help support those customers. And also, sometimes what we do forget about at the end of it is there is still somebody who's living in this property that needs a home. So we'll try and adapt, and we'll try and tweak where we can so that more people can have housing that they can afford as well. Because the one thing that has happened, as we mentioned, because the rates have increased so much, rent has had to go up to catch up, which hasn't necessarily helped with overall the cost of living. So then we look at, well, from a stress rate perspective and an interest rate perspective, what can we do? And we always try to take a relatively considered approach in our interest rates and our fees. We try to be relatively for us. I know there are conversations in the background, which obviously, bearing in mind it's a recorded thing at this moment in time, I'm not sure when it will go live. There will be some tweaks and changes to our products criteria over 2025. So as far as I'm concerned, that's only going to be of a benefit, and therefore I'm very happy that it's going to should be a good year for us as a lender, because we are looking at innovating and changing, and kind of going with the needs of the market, really.
Well, fantastic. I'm going to predict that 2025 is going to be the year of the broker.
Yay!
And I know that lenders will appreciate that as well, because you want properly qualified, and I'm sure you prefer educated and informed applicants coming through to you. So I think there is going to be more of a need for brokers. I absolutely 100% say that all landlords should work with a reputable broker. To me, they're like a partner in the business, and they really do help guide and inform and plan, along with a tax advisor, as Victoria rightly mentioned. So all that remains is for me to say thank you very much to both of you for joining me on the Lenders Roundtable, the last one of the year, and also to thank our viewers for joining us on the call. And we'll see you next time in good old 2025, and it will be interesting times ahead, no doubt. But for now, thanks and goodbye.
Thank you so much.
Thank you.
Merry Christmas.